Greetings. The second quarter of the year was characterized by a familiar theme of persistently high core inflation in developed market countries, leading to increased policy rates and changes in market expectations. Bond yields rose, particularly at shorter durations, and yield curves continued to exhibit inversion, indicating a possible recession ahead. Despite these challenges, equity markets performed better than anticipated, driven by the AI boom and the success of ChatGPT. Developed equity markets performed well in the second quarter, particularly in the US, where mega-cap tech stocks led the way, resulting in strong returns for the S&P 500 and the FANG Plus index. In fact, the dominance of the US mega-cap stocks has been remarkable, with the top 5 stocks contributing the most to the returns we have seen so far this year. In contrast, European markets face challenges due to economic headwinds and hawkish central banks, resulting in modest gains. Asian markets were hindered by concerns over the Chinese recovery, with China experiencing negative returns. Japan was the only major market equities to outperform the US, although weakening yen offset these gains in USD terms. In terms of fixed income, bond yields increased during the quarter, especially at shorter durations, as expectations for the policy rate at the end of 2023 rose. The asset class returns shown in the top table were reflected in the returns of our global solutions. The Global Cautious Fund returned minus 0.7% for quarter 2, on the back of its relatively higher allocation to global bonds, which returned minus 1.4% for the quarter. The Global Managed and Global Growth Funds fared better, returning 0.9% and 3.2% respectively, given their higher allocations to equities, which continue to produce strong returns. What is clear from this slide is that the importance of staying invested through the cycle. This year, we have seen a decent recovery from the sell-off experienced in 2022, which again emphasizes how quickly things can change in markets, both on the upside as well as the downside. The funds have a long track record of meeting their global cash return targets over time, with the cautious, managed, and growth funds delivering 28.7%, 80.1%, and 128.3% cumulative returns in USD, respectively, since their inception in 2008. The Rand-denominated feeder funds have also delivered great returns since their inceptions, with the Global Growth Fund delivering double-digit returns across all the major time periods. As these feeder funds consider currency movements, the fund's attractive returns emphasize the importance of hedging against the depreciation of the Rand over the long term by externalizing some offshore assets. During the quarter, we increased our allocation to both nominal and inflation-linked bonds, as sharp rises in interest rates and bond yields are generating some of the best opportunities in safe haven government bonds in many years. We further included an allocation to an alternative asset class in the form of music royalties. This opportunity was accessed through Roundhill Music Royalties Investment Trust, a trust which possesses a unique collection of music intellectual property royalties and is trading at a significant discount to its net asset value. What sets music royalties apart from more traditional asset classes is its uncorrelated but steady income stream. Furthermore, the global music industry revenue has grown substantially since 2015 and is expected to continue to grow at a compounded annual growth rate of 9% from 2023 to 2030, allowing Roundhill Music Royalties Investment Trust to benefit from that potential growth. As I conclude, the immediate outlook calls for continuing caution. We remain patient before adding to risk assets after the unexpected strength we have seen from equities this year, and are looking for opportunities to add to duration in fixed income, taking advantage of attractive returns now available. As we wait for the turn in economic and market cycle, which will inevitably come, we advocate a long-term and well-diversified investment approach, continuing to blend equities for longer-term growth with some more defensive asset class, including inflation-protected government bonds, infrastructure, and gold. Thank you.